substantive procedures and tying those to the assertions. Okay. So let's just kind of go through the key steps in our audit approach, in designing the audit approach, right? And so I'm going to take you back. We're going to talk a little bit about planning, right? So obviously the first thing you're going to do, steps 1 and 2, involves your preliminary planning, right? Your audit planning. And you're in the planning stage. You're identifying the client business risk. You're looking at the industry and the external environment, looking at what are management's objectives and what are the business processes and how do they affect the financial statements, right? So that's there. You're probably going to do some preliminary analytical, you're not going to probably, you are going to do some preliminary analytical procedures, right, to identify where there are potential risks. So in this case, we're looking at the sales and collection cycle. So in your analytical procedures, you're in your planning phase, and you perform some analytical procedures. You're looking at, let's say, you're looking at sales for the current year versus sales for the previous year, and you see that sales are on a decline. Like sales have declined, and then what might that tell you? Sales have declined. What information do you get from that other than sales decline? What's the risk here? What are some potential risks? Seeing a decline in sales. And let's just say that it's not consistent with industry. Industry sales are stable. John?
The going concern principle, they might be comparing visits maybe not with
So if the sales are, if the decline is significant enough that it's impacting their ability, their cash flow, right, their operations, then going concern might be an issue. So that's something that you would have in your mind as an auditor. What else? So you might look and you might ask, is there a sales decline because there might be fraud going on? What's going on with controls? How effective are controls? Has there been any change in the internal controls? What other risk? Sales are declining, but the industry is stable. What about inherent risk? What are some of the factors? No takers? Victoria.
I guess you could say there's more motivation for the, upper management to commit fraud because they're under pressure.
Right. You might consider, it's like, oh, sales are declining in industry, they're in a competitive industry. The industry sales are stable. So, does this create an environment where management would be more apt to manage earnings, right? Because they're trying to keep pace with prior year numbers and keep pace with the industry. So in here again is if there's a greater incentive to manage earnings, perhaps, what are the controls around the tone at the top and internal controls in general to prevent or detect that on a timely basis. So those are the things. So your analytical procedures, you're not saying that fraud occurred, you're not saying that there's not a legitimate reason for sales to decline, but it raises an area where there's potential risk that you'd look at. Another analytical procedure you might perform would be that sales are declining, and you're looking at the relationship of accounts, because that's an analytical procedure that you would perform. You see sales declining, but accounts receivable is growing. What's your risk? You know the relationship between accounts receivable and sales. Does that relationship make sense to you? I heard a yes. Why does it make sense? Right, but sales is grown, accounts receivable is growing. So right, you hit part of it, right? Your sales are going down, but I'm seeing accounts receivable go up. We sell on credit. We're not collecting cash, right? So we're not collecting on our accounts receivable. Because if for accounts receivable to go up, and it's okay for it to go up. It either means that the company's extended or changed their credit granting policy. So in other words, they're allowing their customers to take a longer time to pay. I don't know if that's such a great business practice. Or that they're not collecting on their accounts receivable. Jimmy? Well, you would kind of know that, right? You would know that going in, right? But still, even if it's mergers and acquisitions, right, you still have, so you still pick up the sales from the merger, right, or the acquisition. So there's the relationship between accounts receivable and sales should survive that, right? Because you would expect to see sales, it would still, you could say, yeah, they acquired another company, and that company was, and maybe it is that company, they got that company really cheap because that company was mismanaged or was losing money. They purchased them, so they took on these bad accounts receivable, right, because there was something else attractive about that company. So that's quite possible, but it still doesn't change the relationship between sales and accounts receivable, that there's a potential problem when you see sales are going down but accounts receivable are going up, right? So you're going to want to look into that. And so when you look into that, you might find that the company had acquired a company, and this was the characteristics of the company, and this is why we're seeing that trend, right? But it's the point of it